Hello, good afternoon. My name is Julian AREVALO. I, first of all, I wanted to say thank you to the Institut des Actuaires for inviting me and giving me the opportunity to present the EIOPA's work on the area of big data analytics and digital ethics. I am just a couple of words on myself. My name is Julian AREVALO. I work for EIOPA, which is the European Insurance and Occupational Pensions Authority, so the European authority that supervises the insurance sector and the occupational pension sector in cooperation with the national authorities. And yes, I'm working on different topics in the area of financial innovations, and in particular on the topics that we are going to cover today. I have a few slides in this presentation, which I will proceed to do now. And after the presentation, I will have a look at the chat and try to answer the questions that you may have. I hope that, by the way, that you are all hearing me well. Maybe I should look at the chat to make sure that this is okay. Yes, I think it's fine. So I start my presentation. First of all, I wanted to quickly introduce EIOPA's approach to Insur Tech or to financial innovations in the insurance sector. We follow a technology neutral approach in the sense that we are aware that there are many benefits of financial innovation, but there are also some challenges that need to be taken into account. So we want to strike a balance between these benefits and risks and try to promote as much as possible responsible financial innovation in the insurance sector. How do we do this? Well, we try to follow a multi-stakeholder approach. Bear in mind that a lot of these topics are very quickly evolving and are relatively complex. So we try to engage as much as possible with stakeholders in the insurance and pension funds industry. We organize roundtables, and we have also recently created a group on digital ethics, which I will present afterwards. And also we try to follow a multidisciplinary approach. 3 years ago, we created at EIOPA what we call the EIOPA's Insur Tech Task Force, which basically is a working group of with representatives from the different national insurance and pensions supervisors, which have different backgrounds. So some colleagues have a more prudential and financial stability background. Other colleagues come from the consumer protection department. We have some IT guys and data scientists. So this is we try to get as much as possible different views and different perspectives into the different types of innovations that are taking place. I will present here today two works that EIOPA has recently done and that is currently doing. On the first place, I will most of my presentation will cover the thematic review that we did at the EIOPA. We published last year in May 2019, and it's based on data collected from the insurance industry in 2018. So bear in mind that the fast pace of developments, some of the data might be outdated already, even though if it's only 2 years ago when we collected the data. But on the other hand, I think it provides a good overview of the state of play of big data analytics in the European motor and health insurance sector. It's based on a survey on data that we collected from 222 insurance undertakings and intermediaries from 26 member states, covering more or less around 60% of the gross written premiums in the respective jurisdictions. So, of course, we were not able to share the survey with all the stakeholders, but I think we received quite a good number of responses, and the data that we collected provides a good overview of the state of play of in the insurance sector in 2018 and to a certain extent already today, also today. So, of course, data is at the very core of the insurance business. Data is collected for, as actuaries, you very well know, for pricing pricing risk, to assess claims, for marketing purposes. So this development that you can see on the slide that is currently shown, this exponential increase in data for during the past few years, mainly as a result of the increase in use of the internet and of mobile phones, and well, and also of the Internet of Things is a very relevant development for the sector. So this is creating more and more data, which is very useful for a data-hungry industry like the insurance industry. So this triggered our attention, and that's a little bit the background why we decided to conduct this thematic review, this analysis of big data analytics in the European insurance sector. There are different types of data used by insurance firms. Of course, as you will know, there are traditional data sources like exposure data, type of car, value of the contents, loss data from claims reports of car accidents, liability cases, population data, mortality rates, etc. And these are complemented by more and more by new data sources enabled by digitalization. IoT data, I already referred to it, data collected from insurance companies' websites and mobile phone applications, geolocation data, genetics data, bank account, credit card data. So based on this classification of data sources that was developed by the Geneva Association, we slightly amended it. We asked the insurance sector to what extent these types of data sources were already being used, or they expected to use them in the next 3 years. So we wanted to have this bear in mind this fast evolution of developments. We also we asked the insurance companies for the current practices in 2018, and with a view also what were the expectations in the next 3 years. So that will be more or less today. And in this slide, you can see that as expected, the traditional data sources are still used in a greater extent than new data sources. The traditional data sources, you can find them on the left side of the slide, and these new types of data are on the right side of the graphic that you can see on your on the slide. But maybe just to make reference on this last type of new types of data sources, data collected from the websites and from mobile phone applications was in 2018 the data that was more used by the innovative data that was used by insurance companies, followed by IoT data collected from car telematics or health wearable devices. Bank account and credit card data was used by around 20%, 20 companies out of 222, so broadly 10%, and a similar percentage expected to use this type of data in the next 3 years. And we were maybe a little bit relieved for the fact that genetics data, which as you know has some controversy around it, was not used by insurance companies in 2018. We also asked the industry to let us know from where these data sources were coming from. So if they were internal or they were obtained from external data sources from third parties. And as you can see in the graphic, the outcome of our analysis was that there's quite a mix of data sources, both internal and external data sources are, are, are used in the insurance industry. We bear in mind that this greater amount of data needs to be stored somewhere. We asked insurance companies to what extent they were using cloud computing services already in 2018, and as you can see there in the graphic, around 1/3 of the companies that participated on our survey were already using it, and another third expected to use it in the next 3 years. And maybe surprisingly, 1/3 said that they had not plans in the near future to use them, but maybe with the time, these changes, these companies have decided to adopt a different approach. When it comes to cloud computing, there are different types of services provided, from the very basic storage services, what is called IaaS, infrastructure as a service, to more comprehensive services, which is commonly referred to as software as a service. And here I would like to highlight this type of machine learning applications that cloud computing service providers such as Google, Amazon, or Microsoft, well, they offer this kind of services to their clients, including insurance companies. And the feedback from the industry was that cloud computing was indeed perceived as a key enabler of agility and data analytics. Maybe just also on this area, you might be aware, but EIOPA looked into this topic more concretely on a separate work stream last year, and earlier this year, EIOPA published some guidelines on the outsourcing of cloud computing services to provide a little bit more clarity of what were the supervisory expectations in this area. We questioned insurance firms to let us know to what extent they were already using in 2018 tools, big data analytic tools such as artificial intelligence and machine learning. In 2018, based on our information, 30% of the companies were 31% were already actively applying it, and 20 to 24% were at a proof of concept stage. This also varies greatly from jurisdiction to jurisdiction, and indeed in some jurisdictions, like for example, the UK published their own standalone analysis of artificial intelligence and machine learning in the UK financial services sector, and there it showed that the adoption of artificial intelligence by the insurance industry was 100%, greater even than in the banking sector. That was the conclusion of the UK Financial Authority and the Bank of England's study. Where are these tools used? That's on the graphic, on the chart that you can see on the right. Mainly in pricing and underwriting and for claims management, including fraud prevention purposes, but also on sales and distribution, marketing. This is also an area of the value chain that where these kind of tools are used. Most of the firms that stated that they are actively applying artificial intelligence are not only applying it on once, but they have different types of use cases across the insurance value chain. We asked for what type of use cases were these type of artificial intelligence and machine learning tools used in insurance. Some of the use cases that we identified, you can see them on the graphic, on the graphic shown in the slide. from churn models to detect which customers are more likely to shop around or not, which can be used for price optimization practices, to chatbots. Some companies refer to the use of Facebook chatbots in social media, back office operations like electronic document management, of course, in claims management and fraud prevention, and pricing and underwriting. In this slide, you can see here, as I was saying, we wanted to see what was the current state of the use of big data analytics in 2018 and in the next 3 years. And if you look at the gray colors of the charts, so the graphic on the left, you can see where insurance companies reply that big data analytics had a greater impact to date, pricing, underwriting, and claims management where they had a greater use. In their view, in 3 years, this will also be the case, these areas. But what is also interesting is to see that the impact is expected to increase throughout all the areas of the value chain. Internet of Things, telematics are a very promising development for the insurance sector. And therefore we had specific questions in our survey on this type of usage-based insurance products, which are linked to the data collected from. So we were focusing on motor insurance and health insurance. So therefore collected either through connected cars or black boxes or mobile phone applications, also tracking the driving behavior of the consumer, or health wearable devices also, or such as fitness trackers or bracelets, or mobile phone applications also are the ones that are used to collect this type of information. And in 2018, the penetration of this type of products was very low, particularly in the health insurance in the health insurance line of business. But in 3 years' time, insurance companies already around 50% of the motor insurance companies already foresaw to have some type of product offering linked to this type of innovation. And of course, there you can see it's a little bit small, but you can see the type of data that is collected through these technologies, and the type of services that are provided vary largely from one provider to another, but they generally are for risk mitigation and prevention purposes, like offering premium discounts or coaching services for those that have a good driving behavior or a healthy lifestyle, which this can be a way to prevent prevent risks. So this is an interesting and very positive development. But of course, this data, especially when it comes to health wearable devices, then it has to be handled in a responsible way. If we go a little bit through certain use cases in the value chain, there on the graphic on the left, you can see now the penetration of robo-advisors in insurance. And maybe it can be a little bit misleading because based on the information that we gathered, only 2% of the companies were using robo-advisors. But of course, robo-advisors are less relevant in motor insurance compared to, for example, life insurance. So maybe we have included in our analysis the life insurance sector, then the penetration of robo-advisors will have been greater. And chatbots seems to be a very popular or relatively popular tool, and yeah, many companies were expecting to use them in the near future. and maybe for low to reply to low sensitive questions from the consumer, or to guide them through the website. These kind of services were provided through chatbots. Claims management is an area where big data analytics can have a lot of use cases. There in the graphic, again, it's a little bit small, and apologies for that, but you can see different type of specific use cases in claims management. Maybe just to highlight that in 2018, the biggest use of big data analytics was for enhanced fraud analytics. But interestingly, in 3 years' time, so maybe now, most of the insurance companies expected to use for loss assessment and repair, so to assess automated damage value estimation based on picture or video recognition. So this is indeed a very promising development. And yes, this was the outcome of our survey. Moving forward, also from a supervisory perspective, also from a risk management perspective, we wanted to know the use of third parties in the area of big data analytics, third-party service providers. And there we found that for certain more novel technologies, like for example chatbots, then the use of third-party service providers was greater. So this was a technology that was more outsourced compared to other areas of the insurance value chain, such as claims management. So maybe this is not so much surprising, but maybe it's still relevant. So the key conclusion from here was that the outsourcing activities are considered as a key enabler to get quick access to new technologies and innovation models and innovative business models. Pricing and underwriting was an area of the value chain where we made special focus on our survey. We wanted to know how was big data analytics impacting this area of the value chain in detail. And among other things, we collected data on the types of rating factors that were used by insurance companies. As you can see in the graphic, some of them, this is a cluster that we try to cluster the different types of rating factors in different categories. And broadly, we separated the ones that we saw as having a direct, a more obvious causal link, and others where the causality correlation was a little bit more indirect. And so this is also a relevant topic for the work that we are conducting on digital ethics, that I will a little bit address in the following slides. Also in pricing and underwriting, we try to gather information on the potential financial inclusion and exclusion of consumers. And for this, we gathered the information of different indicators that we developed. Of course, it was difficult to analyze this topic in detail due to the lack of harmonized data at the European level. We gather information, so for example, on the evolution of the standard deviation of the insurance premiums, or on number of risk pools, the evolution from one year to another. And well, our conclusion on this area was that to date there was no evidence that financial exclusion of consumers was taking place as a result of big data analytics, which was a plausible result of more accurate, increasingly accurate tools combined with more and more data sources. So we didn't identify that we didn't find evidence of this financial exclusion. But on the other hand, insurance companies agreed that they expect that this phenomenon will develop in the next years, the near future. So with all this information, we tried to come to some conclusions, and the supervisors, we try to, as I was explaining in my first slide, we try to address these innovations, assessing both the opportunities and risks, opportunities and challenges. In this slide, we reflect the views of the insurance industry. So we asked specifically to let us know from some opportunities and some challenges that we had identified to ask the insurance companies what were the views, and based on this information, we were able to categorize these opportunities and challenges. And I think from a supervisory perspective, we broadly agree on the feedback received from the insurance industry. When it comes to opportunities, maybe to highlight the fact of the development of more tailored products and services, improve fraud analytics, and enhance risk assessment. And when it comes to the challenges, well, here maybe we don't agree so much. The insurance firms replied that the challenge was to meet the regulatory requirements. Well, maybe I'm not sure if they were referring to insurance legislation or general data protection legislation, which is relevant in this area. And for example, the explainability requirement included in the GDPR Article 13 to provide meaningful explanations. Well, this to a certain extent can be challenging to comply with for insurance companies. And yes, then especially on the challenges regarding data accuracy and fairness and ethical, these are the two areas where we are going to focus. Where we as supervisors were the two biggest challenges that we identified. You have probably heard talk about the black box artificial intelligence and machine learning algorithms, where this is an issue that is of interest certainly for us, and for sure for market participants as well. So this is an area where, as a follow-up of our thematic review, we are looking into it, and also the fair and ethical use of data. Here on this slide, you can see the approach followed by the UK's financial authority, the FCA, which is a little bit more advanced compared to other jurisdictions in analyzing this type of issues. And there you can see that the differentiate between the lesser desire to act and the greater desire to act, and depending on who is harmed, how much is harmed, what's the impact on vulnerable consumers. So I think that this approach of the FCA is relevant for European supervisors across Europe. So how did we decide to address these issues? So we created an expert group, a stakeholder expert group on digital ethics in insurance. So this brings me to the second work stream that I wanted to present to you in this webinar. I must say that it's while the thematic review on big data analytics was already published last year, so I was able to develop that a little bit, to expand a little bit on it. Here, I will just provide a high level overview of what it is and what are some of the key considerations that are being considered in the group, but it's work ongoing. So yes, the information that I can provide is still limited. But yeah, so as I was mentioning, we created this stakeholder group composed from 40 stakeholders with representatives from the insurance industry, consumers, representatives, and academics. It was created in October 2019, and the objective was essentially to discuss these issues that we had identified in the thematic review on big data analytics and try to identify ways of addressing them in a responsible manner. The objective is to develop some principles on digital, what we call digital responsibility in insurance. That will be specific to the insurance sector, address how new technologies, data sources, and business models are developing in the insurance sector. Focus is on pricing, but other areas of the insurance value chain is also relevant, and our primary focus is on the impact of these technologies on retail consumers. The work of the consultative expert group on digital ethics is expected to be finalized at the end of this year. But maybe just a few words on the approach that we have adopted. On this slide, you can see it was developed. This really, I'm sure you cannot see that. I cannot see it myself either. But it was, I think it's a nice slide because it was developed by the Harvard Law School and shows that there are many different initiatives in the area of AI principles, both from the public sector, but also from the private sector at a sectorial level. And the colleagues from the Harvard Law School, they aggregated all of them and identify some key commonalities to all of them. And that you can see, if you click on the link, you can see the more in detail. But the one circled with a red circle on the bottom of the main circle, there shows the work developed by the European Commission's high-level expert group on artificial intelligence, which in June 2019, last year, they developed some AI ethical guidelines, which particularly, notably, they comprise 7 key requirements for ethical and trustworthy AI. These requirements are the ones that you can see: human agency and oversight, technical robustness and safety, privacy and data governance, transparency, diversity, non-discrimination and fairness, societal and environmental well-being, and accountability. So on the group on digital ethics, we want to take as much as possible this work, being European supervisors. Of course, we could choose any other of the initiatives that have been developed across the world, but of course we follow more closely the developments at European cross-sectoral level. So we want to leverage as much as possible on this work, cross-sectoral work from the European Commission's high-level expert group on artificial intelligence. We have created from the 40 stakeholders, we have divided them into 3 work streams, and each of the work streams is asked to address some of these requirements that I was mentioned before, developed by this high-level expert group on artificial intelligence of the European Commission, and give them a little bit a focus and put them into an insurance context and see how these principles they apply in the insurance sector for concrete use cases across the insurance value chain. Work is ongoing. Maybe just to highlight, since this is the Institut actuaires, we are the 3 work streams are chaired by 3 actuaries. Actually, the 3 actuaries that are members of the stakeholder group. And yes, work is on progress. We have a call next week to discuss recent developments, and yes, hopefully we manage to progress and provide something useful which doesn't reinvent the wheel, but at the same time it's useful for both for all the stakeholders in the insurance industry, but also for supervisors, including supervisors. The approach that we want to follow is a risk-based approach. So we want to assess. We are of the opinion that the concrete all these requirements need to be adapted to concrete use cases, and some use cases have a higher risk of harm, which is assessed from the likelihood, the probabilities of likelihood or of severity, and some others, like for example back office operations, they could probably be characterized by a lower risk. So these requirements or should be lowered compared to these governance measures around the AI use cases should be lower when it's a low risk AI application compared to a high risk AI application. We want to take into account the opportunities and challenges. So of course we focus on consumer protection and financial stability. That should be the priority. But we also know that this is an area which is developing. So we want to keep an open minded and if necessary with a certain framework we are open to take some risks. Be reminded as I said, the opportunities and challenges. In this slide, you can see the different types of machine learning algorithms, and it's a high-level overview of their characteristics. But I thought it was relevant to highlight that there's normally often a trade-off between the explainability of these algorithms and its accuracy. For example, the decision trees are highly explainable. Well, also depends on the dimensionality, no? But highly explainable, but arguably they are less accurate than if you compare it, for example, with an artificial neural network or a deep learning networks, which on the other hand are more opaque or more black boxes. So some of the issues that are being discussed in the GDE, there are many open topics, and as you can expect from the different backgrounds of the 40 stakeholders of the expert group, then there are many different views. For example, when it comes to fairness in pricing, what does this mean? Here, what we are discussing issues such as price optimization practices or the risk of undetected bias in the training data, which can lead to discrimination. These are topics that are being discussed and try to identify possible ways to address them in a proportionate manner. What type of explanations need to be provided to the different stakeholders? We from a starting point, we assume that the different stakeholders did different types of explanations. So the information that needs to be provided to a consumer is different to the information that needs to be provided, for example, to the supervisor or to the auditors, for example. We are aware that we have in mind these artificial intelligence, machine learning algorithms, their opaque nature. There are certain explainability tools like Lime, SHAP, etc., which already provide some light into the black box, and there we are discussing possible differentiation of local explanations and global explanations, but this is still a work ongoing. From a governance perspective, we want to leverage as much as possible on the existing governance framework in the insurance sector, implemented namely by Solvency II. So, but there are discussions about if there's a need to develop or not an AI strategy, AI guidelines when an insurance company is using artificial intelligence, especially if it's across the different areas of the value chain. Maybe if you have if an insurance company is using one small chat box only, then arguably you don't need an AI strategy guidelines for only that use case. But also the content of these guidelines or the updated it's also possible to update existing guidelines. So what should be the content? What kind of communication is to be provided to the different staff involved in the development of AI solutions, applications in that insurance company. And the role of Actuaries, this is also an issue that is being debated. Actuaries, according to Solvency II and EIOPA's guidelines on system of governance, they are one of the 4 key functions of the insurance undertaking. And the question that is how to leverage on your expertise on data analytics, data quality assurance, etc. So there are different views amongst the members. Hopefully, we can reach an agreement. There are many other open issues, but these are just some of them. And with this, I finalize my presentation. I will have a look at the chat to see if there are any questions. Have you noticed any use or intention to use AI machine learning? So there's one question from Khalil. Have you noticed any use or intention to use AI machine learning in the solvency capital requirements computations? The use of artificial intelligence machine learning for the calculation of technical provisions is a use case that we have learned about through the group on digital ethics. It didn't come out in our survey, but this is a use case that we have learned about. Of course, if this type of use case will need to comply with the Solvency II legislation, which is quite detailed, and to what extent they can comply with it, I think will depend to the insurance company to show it. But yes, so the answer to that question is we have learned, we are aware of this potential use case to calculate the technical provisions. There's another question from Benoit Gros-Lafeche. Do you know if robotic process automation is used in insurance companies? The answer is yes. This specific use case was reported by a small number, I must say, of insurance companies. So yes, that's the answer. I think this particular use case was essentially to filter emails or to distribute the emails to the different departments. Then there's another question from Rasem Katata. Sorry if I pronounce wrong your name. What will be the future of traditional insurance facing the GAFA? This is a GAFA. It's indeed a potential new player. It's already a player in the insurance sector because, as I mentioned before in our presentation, they are already providing as third-party service providers, particular cloud computing service to insurance companies. So insurance companies are their clients. We did include a question about how insurance companies themselves were seeing the threat of GAFA to the insurance sector, and there were diverging views. I think that the biggest fear for insurance companies was that the players such as Amazon will enter the distribution of insurance products. So the expectation was that they were most likely focused on the distribution and then enter into agreements with insurance companies for the risk-taking activities. This was a threat, but to date, I think it has not materialized, with the exception of some products that are already sold as in combination with some tools that some products that you may buy in Amazon. So, for example, for extended guarantees of a TV that you buy there, I think there were also rumors that Amazon wanted to enter the distribution of motor insurance in the UK, and I heard rumors that they had received a license for that, but I think it has not materialized, or not that I'm aware. some insurance companies still with GAFA, they argue that yeah, they have access to large data sets of non-traditional data, and if they use this, they could arguably provide more accurate risk assessments than what insurers do with the traditional data sources. Of course, another question will be the issue of correlation and causation. But finally, from on GAFAs, another group of insurance companies consider that and mentioning, for example, the failure of Microsoft, which at some point developed Google. I think it was Google who at some point developed a price comparison website, but in the end they closed it because they were not receiving so much benefits, and they were endangering their potential clients, so they closed. So mentioning this, a large group of insurance companies consider that these GAFAs will most likely focus on the provision of this cloud computing and machine learning applications to providing these services to companies. There's another question from Chloe Nicolas, and decided to keep usual models, non-AI models. Have you experienced any companies that Chloe Nicolas? So the question of Chloe Nicolas is, have you experienced any companies that use AI in order to improve their models and have been disappointed? There were one or two cases in our thematic review that mentioned that they had experimented with a chat box, and eventually they had decided not to use it because it was too burdensome to continue update. Also, these tools need to have access to large data sets to be trained. So if you don't have such the broad consumer base, for example, maybe it's not that easy to train it and to develop it. So on this particular use case on Chatbox, I did remember there was a company that mentioned that they had stopped using it. Maybe when it comes to the IoT data, I think there was also a case of an insurance company that stopped using IoT data in their product offering, but there was just there was very residual these examples. So then I guess these companies went to business as usual and to use more traditional business models. And that was the second part of the question from Chloe Nicolas. Brigitte Dubus asked, how do I see the role of supervisors? So it's a good question, and it's an issue that we are analyzing together with in parallel to these two work streams. We had we at the EIOPA we had another work stream where we analyzed the issue more concretely, the issue of supervision of machine learning algorithms, and it was a desk-based assessment where we analyzed some of the different types of algorithms, their benefits and risks, in terms of explainability. We analyzed also the different. So I think we are all in the learning curve. So we try to understand to what extent these explainability tools like Lime or SAP or other tools provide the meaningful explanations. We are aware that this is an area of intensive research, so the conclusion was that these tools provide already some relevant information. It's uncertain to what extent it's 100% accurate or not, and basically we came to our preliminary conclusions, but we want to wait until the work of the group on digital ethics is finalized, because we also want to leverage on their knowledge and experience to better understand these developments, and after that we and use this into our activities as supervisors. I must say that yes, so supervisors they have the responsibility to to ensure consumer protection and financial stability, and this must be the priority for supervisors. But on the other hand, we are, I think I mentioned it before, we try to approach it from an open-minded. We want to accompany as possible, as much as possible, the developments with the industry, with close stakeholder dialogue, supervisory dialogue, and we are learning, and we are learning, and I likely will focus more in the more concrete use cases in the future. But this is an area that's still being considered, and as I mentioned, we want to leverage still on the work of the group on digital ethics, and importantly also the European Commission has also, in addition of this high-level expert group on artificial intelligence AI ethical guidelines that they published last year, the European Commission has issued a white paper on artificial intelligence where they outlined a possible regulation on artificial intelligence. It's to a large extent, this white paper of the European Commission is to a large extent based on the 7 requirements on the high-level expert group on digital ethics. But of course, if eventually there's a regulation on artificial intelligence, which I understand that is expected for the end of this year to be published. Once it's so the legislative process in Brussels normally takes 9 months since from the moment that it was published. So that will be, if everything goes well, it will be adopted at the end of next year. But then also it takes a couple of years to be implemented. But these are all developments that we have to take into account and closely monitor them. There's another question from Saman Nejat. Hello, do you know if some European insurance companies already use connected watches for their customer? And the reply is yes, based on our thematic review on data analytics, on big data analytics. Some companies was a minority compared to the motor insurance companies, but some insurance companies were already collecting this type of information through fitness trackers or a smartwatch. And I think to price insurance risks, it was a very small number of them. Maybe now it's different, but yeah, most of these health insurance using this data collected from wearable devices were using them to provide incentives, to adopt non-monetary incentives like coaching, etc., to adopt healthy lifestyles. There's a question from Roger Vincent. How did you address the way insurance intermediaries, insurance brokers, agents use AI and machine learning for consumer profiling, cross-sells, retention? So here in our study, we the big data analytics thematic review, we gather information both from insurance undertakings and insurance intermediaries. One first conclusion from this was that the penetration, maybe not surprising, the penetration of AI ML in insurance intermediaries was considerably smaller than for insurance undertakings, but some of them do use it indeed, and our expectation is that the conclusions and these principles of digital responsibility that our expert group will produce later this year will apply to insurance intermediaries as well. And we are aware that, of course, the the regulation for insurance intermediaries, at the European level at least, the Insurance Distribution Directive is a minimum harmonization directive, so it's much less comprehensive than when it comes to Solvency II, which have very detailed requirements and governance requirements. So this is an issue that, yes, we are aware of it, and as I mentioned, our expectation will be that the principles of digital responsibility will also be implemented by intermediaries as well. It's already 6 o'clock. I think that was the time that we had scheduled for this webinar. I don't see any more calls, so I would like to thank you all for. I don't see any more questions. Sorry. So I would like to thank you all for attending this webinar. I will share the presentation afterwards with Florence, and then if you have any questions, you can always send an email and reach out, and we are always happy to engage and discuss topics with the industry. So thank you very much, and goodbye.